Australia, I think, is number 6 in the world in terms of university research. When it comes to actually commercialisation, number 30 in the world. And when it comes to actually complexity of innovation, we're about 105. So you can see there's a huge gap between the amount of research that gets produced and then the successful innovation outcomes that come out of it. What we saw was an opportunity as a venture capital firm to come in and actually help the universities improve that ratio of research to innovation success.
Hi everyone, welcome back to our executive interview series. I'm your host, and today's conversation is with someone who believes Australia's greatest untapped resource isn't in the ground, it's actually in our university labs. So today we have with us Guy Hedley, the founding partner from Stoic VC, and he's spent the last 7 years proving that the gap between breakthrough science and breakthrough returns is smaller than most people think. Guy, welcome.
Thank you very much. Nice to be here.
Amazing. Now, Guy, you've been in the financial markets for nearly 4 decades. So you've seen some incredible cycles, built businesses, weathered some really tough storms. In 2018, you made that leap to start Stoic VC. So what was that moment when you actually thought that I need to build something different?
Sure. So one of my partners, Dr. Jeff Waring, who was actually my old business school professor when I did my MBA, approached me and said, look, I've got a good relationship with Australian universities. Australian universities have a collective venture capital body called UniSeed. And he said, I think there's an opportunity for us to partner with UniSeed to help commercialise Australian research. Right. That was the genesis of it. Yeah. And fast forward now to 2025, we're now 7 years through that journey.
Amazing. That's truly wonderful, the product that you've built. Now, you mentioned in your bio that you're quite fascinated by people making positive change through extreme adversity. So is that what drew you to backing these university researchers who are literally trying to solve what you call the worst, most intraceable problems?
Yeah, sure. I mean, I think if you understand the way that university research works, Australia, I think, is number 6 in the world in terms of university research. It's phenomenal in OECD. But when it comes to actually commercialisation, Australia ranks number 30 in the world. And when it comes to actually complexity of innovation, we're about 105. So you can see there's a huge gap between the amount of research that gets produced and then the successful innovation outcomes that come out of it. I think what we saw was an opportunity as a venture capital firm to come in and actually help the universities improve that ratio of research to innovation success, which is what we're now seeing. We're now seeing that happen.
Right. Absolutely. Now, here's a statistic that actually stopped me. So, like
Sure.
you mentioned about Australia, being ranked 6th in research output, but like when we talk about economic complexity, it's like 105th.
Fifth,
So
yeah.
that's a big gap. So can you tell us what did you see that made you think about this brilliant research that Australia is doing, and why this gap? Like, where is
Sure.
Australia getting stuck?
So I think the gap comes back to Australia's I mean, I think anyone who's been to an Australian university knows the quality of the education experience is very high. The problem is we're a small country. We're 25 million people in a global market, and if you really want to commercialise and create great IP, you need to access the global market. Yeah. I think that's where the equation falls down quite badly, because for a researcher coming out of with a fantastic idea or a brilliant innovation or a drug discovery, very hard for them to actually access global markets. And so I think we saw, because that's what we do, we effectively access the global market, our ability to step in and help those companies find what are quite often are both resource and funding solutions internationally is the critical missing ingredient.
Amazing. Thanks for explaining that. Now, like you mentioned about your partnership with UniSeed, so in which you get first look access to 65 of Australia's university pipeline. So for our investors watching this interview, can you walk us through what that actually looks like
Sure.
day to day? And are you sitting in university labs? How does it actually work?
It's a good, so typically the way the universities work is that smart researchers will, who come up with a great idea or a great product, a great invention, will go to the university, what they call tech transfer office. And the tech transfer office is really a dedicated group of people within a university who are helping them to set up, if you have IP you need patented.
Right.
You need access to patent lawyers.
Right.
If you need to form a company, you need actually company formation skills.
Hmm.
So a lot of these researchers will go through that tech transfer office to get to the point where they're ready, organised, patents in place, company formed. Then they'll come to our investment committee, which is a combined university investment committee.
Hmm.
We have both a biotech and a technology investment committee, comprised of each university plus CSIRO, which we sit on both committees. Now that's typically 13 PhDs on each committee who are evaluating all those ideas. The best and the brightest of them we'll decide to fund. Once they're funded, then we write a check. Typically it's as a seed stage investment. And then from there, it's just monitoring, managing, assisting, helping these companies to try and create ultimately an exit out on the global stage.
Amazing. When you explain it like that, it definitely seems easy. Does not seem so
It's not as easy. I mean, if you look at the failure rate, so we're probably looking at about, or the universities in total are probably looking at around about 1,200 companies a year, or 1,200 ideas, innovation, inventions. Of that, maybe half a dozen a year are getting funded.
Right.
So, from the idea, invention, innovation to actually getting a real fundable investment, very hard.
Yeah, absolutely.
And then really from there, again, what we find in terms of venture capital is because these are very IP rich, in other words, they've got patents, they've got, if you call it in modern day terms, a moat around them. The success rate and survivorship is much higher than it is in normal venture capital because there's actually quite often a tangible, defensible patent that sits around whatever the technology is.
Now let's talk about the numbers because our audience loves that.
Love numbers, so do we.
So your fund one is tracking a 21% IRR with your 2019 vintage. That's very impressive. So here's what's really interesting, that you're seeing that there is a valuation arbitrage where Australian biotechs trade at 40 to 60% discount to US peers, but then there is exit at similar prices. So how long can that arbitrage last?
Yeah, it's a good question. I think a lot of, and why does that arbitrage exist? It's because the liability of foreignness, you would think about it. So let's pick a pharmaceutical company that's looking to acquire a drug that's in discovery. Quite often, if it's a US company, they'll say, well, there's very little risk in terms of once we understand the company, we know the company's based in the US market, its team's based in the US market, and acquisition then typically is easy. If they're acquiring a company that's based in Australia, it's much more complex. So quite often the researchers will still be sometimes embedded within Australian academic institutions. There's unpicking that, but then it's just the fact that Australian companies or Australian researchers tend to not have the same focus that a US company does. We think, often think differently. So I think our job is to make sure that we actually close that gap.
Right.
So I think we were talking about this earlier, that some of the best and brightest we've got are now starting to venture out very early into the US market. A number of our investee companies have rebased themselves effectively into Silicon Valley.
Right.
Because the earlier they get there, they can still retain a lot of their research function down here in Australia, but by running their trial programs, by actually facing the US market, they remove a lot of that gap that exists on acquisition.
Absolutely. I understand that. Now, let's talk about your fund two. So fund two is fascinating because 70% is allocated to follow-on investments in your best companies from fund one. So that is a huge conviction play. So can you walk us through that decision, that what gives you that confidence?
So our fund one ended up being fully committed and fully invested. And normally in venture capital, you work on the basis that maybe 1 out of 10 will work. So, in a normal venture capital fund, if you've got 20 or 30 companies, 2 or 3 of them will be knock it out of the park. A few others will survive and give some return, and a lot will fail. Our survivorship bias in our first fund is in excess of 75%. Again, it speaks to why IP is so valuable. But it also speaks to the fact the quality of the companies coming through the university ecosystem is very high. Because of that, we figured that a lot of these companies are going now through Series B and Series C raises. and they're that much closer to exit. If you work on the basis that in drug discovery or normally in advanced technology, it's about a 10-year journey to exit. Because our fund, 2019 till now, there's 6 years track record. For a lot of our Fund 1 investee companies, they're only 4 to 5 years away from exits.
Right.
So we figured, why don't we put together a follow-on fund? The universities were keen for us to do it, where we actually support these companies through their Series B or Series C to exit. But at the same time, because we're still seeing a lot of new deal flow coming through the investment committees at university, we figured we might as well keep an allocation to new seed stage deals.
Right.
So the feature of this second fund is you would expect it to have a lot earlier exit than normal venture capital. We can already see that there's a couple of our investee companies from Fund 1 that will probably look to exit in the next couple of years. And then most of the companies will be exited out within a 4 to 5 year time frame. So very different complexion.
Yeah, amazing. That's great to know. Now, I have to ask this as I read this about your bio. So you wake up at Bronte Beach at 6 a.m. And then I imagine that's when you do your best thinking. So when you're looking out at the ocean, what's the one breakthrough that you're hoping for one of your portfolio companies that makes you think that, this is why I became a VC?
Sure. So it's, the problems we're solving, I mean, there's so many great stories in the portfolio. The problems we're solving are some of the world's biggest problems. And so all I need, I'll give you an example. So we have a company that's actually now monitoring the spore count in the air for agriculture. So it can go into a winery or into a grain crop, set its device up in the crops, and tell straight away whether or not there's any spores that are coming that will infect the crops.
Oh, wow.
And that is a company that started out with 4 young 28-year-old engineers from Sydney University.
Wow, that's
4 or 5 years ago. That's now expanded out globally, just set up its location in London, now going into France, and winemakers in France are taking it up. It's going to South America, it's going global. So I look at a company like that and I think, wow. 4 young researchers with a great idea, and all of a sudden this company could well be a unicorn. Now, that's what really excites me, is that the problem it's solving is, as you get global warming, as you get more of these infections, they got support from the Canadian government to come into Canada because the tundra in Saskatchewan now is unfreezing earlier in spring.
Right.
And because spring is typically a windy time, a lot of the spores are getting released down through the grain crops in Canada.
Right.
So these problems are global problems that these companies are solving. When I'm sitting on the beach looking at the water, I just think that's so great. That's so great.
Absolutely. It's great to be at the forefront. And that's what I love about this space as well. You're not just generating returns, but you are actually changing the world. So that is indeed very exciting. Now, as we speak of returns, for investors watching, Fund 2 is targeting a final close of $30 million in Q1 of 2026. And UniSeed just allocated $100 million to your partnership. So, which is quite serious institutional validation. So for our investors watching, and if they want to understand about this opportunity, what is something that they might not immediately see that, you want to tell them?
Okay, no, it's a good point. So just to explain, so UniSeed is effectively just a collection of universities. So there are, I think I've said, 10 universities, including CSRO, that sit in that partnership. They're all tipping a fixed sum of capital into a pool, and they're investing alongside us. So on the same pari passu basis, UniSuper, which is clearly a $130 billion fund here in Australia, have come on board as a partner in the partnership. They've tipped in a committed capital of $100 million. So between UniSeed, UniSuper and ourselves, we have the ability really to fund transactions right the way through the spectrum. And I think having UniSuper on board is such a critical ingredient, because you need deep pockets for these companies to succeed and get out the other side. If you're taking a drug discovery through to exit, pick a phase 2 trials or something, you could well end up having to write checks along the way for that company of up to $100 million. There are very few venture capital firms that can afford to sustain that level of investment. So having solid partners on board de-risks it. So for investors coming into my fund, they're really lucky. because they've got the universities and their
Yeah.
balance sheets, and they've got UniSuper in their balance sheet,
Yeah.
plus our other co-investment partners, which include some of the biggest VCs in the world, all there to try and help.
Amazing.
It's
That's
heavy
wonderful. Now, Guy, as we wrap up this interview, I would love to hear your final thoughts, like anything you feel that we haven't covered that you want to share with our audience today.
Yeah, look, I think the only thing to share is that when people think about venture capital, they think about often just technology. I mean, I call it, in my old parlance of investing, always avoid fashionable investment. And fashionable investment tends to be things that come and go very quickly. Now, at the moment, the world's enamored with AI. And so a lot of the money that's being raised in venture is actually being raised in AI.
Right.
I think application of technology to problem solving is a better way to think about things. AI is embedded in so many of our companies.
Yeah.
But it's not necessarily the lead thing. It's not AI as an investment. It's that we have a problem we're solving with technology that has a moat around it through intellectual property, and AI is a tool that's being used to solve. So that would be my parting message.
Amazing. That's a great way to wrap our interview today. And the intersection of breakthrough science and the patient capital that we've talked about is exactly the type of long-term thinking that we should all be focused about. That can also help us generate returns. Now, to our audience watching, I hope you found this interview as educational as I did. And if you're interested in learning more about Stoic VC, please see the details at the side of your screen or in the description of this video. Once again, thank you for watching, and thank you, Guy, for being here today with us.
Thank you very much, and thank you.
Thank you.